Hello, my name is Jessica Abella, and I am a tax professional here in the greater Seattle area. Today, we're going to start talking about the impact of the Big Beautiful Bill. Today, we're going to focus on the non-business provisions. Next week, we'll run through the business provisions, and then the following week, there are a bunch of kid-related provisions that I couldn't fit into today's video. So be sure to subscribe, turn on notifications to be notified as those following videos come up. One quick note, there are a number of provisions throughout the bill that require you to have a Social Security number in order to take advantage of whatever the deduction or credit is. So if you or your spouse or your child do not have a Social Security number, please note that these deductions and credits may not apply to you. The specifics are outside of the scope of this video, but it's just something I'd like you to be aware of. So first, we're going to briefly run through what is not changing, and then we'll go over some of the new provisions. The tax cuts from the 2018 Tax Cuts and Jobs Act were scheduled to expire at the end of 2026. We are expecting tax rates to go up for 2026. This new legislation extended those cuts permanently, or as permanently as anything ever is in tax law. Congress can always change their mind. Those lower tax rates and the higher standard deductions, those have been extended. Also made permanent the limitations on your mortgage interest deduction. So if you take out a home equity line of credit and you use it to pay down debt, or you use it to purchase a vehicle or something else that is not buying, building, or maintaining your home, that interest is not deductible. You also cannot deduct your mortgage interest on debt over $750,000. So that has been the rule for the last several years. Still the case, now it's permanent. The deduction for moving expenses is still gone, unless you are military or newly, if you're part of the intelligence community, you're able to take that deduction. The deductions for work-related expenses and investment-related expenses, permanently gone. So if you have home office expenses or something for your W-2 job, you still cannot take those deductions. Those are gone. The higher estate tax exemption amount is also permanent and indexed for inflation at a higher rate. So if your estate is in the $15 million range, you still need to be planning. If you are well under that, you're in good shape. So into the new stuff, and the new stuff is where things get a little more interesting. So if you are over 65, from 2025 to 2028, you'll get an extra $6,000 deduction as long as your income isn't over $75,000, $150,000 if you're married filing joint. If you're married filing separate, you can't claim this deduction. Important to note, there is not a provision in this bill exempting Social Security from tax. This $6,000 deduction is the only thing that was new for senior citizens, so be aware of that. If you are wagering, gambling, you need to know to keep close track of your losses. You should be anyway, but starting in 2026, there's a new limit. So you still can't deduct more than you won. So if you won $1,000, your deduction for losses cannot exceed $1,000, but you also can't deduct more than 90% of your losses. So it's just a new wrinkle in figuring that out. It's going to be really important to know the total actual amount of your losses. The SALT cap, this is state and local taxes. If you itemize your deduction for things like your real estate taxes, sales tax, income tax, if you're in a state that has such a thing, it's been limited to $10,000 in recent years. From 2025 to 2029, that limit increases to $40,000. So that's going to help if you've been running into that $10,000 limit. It'll drop back to $10,000 in 2030 unless Congress acts. If your income is over $500,000, expect this will be limited. If your income is over $600,000, your itemized deductions in general may be reduced. So be aware of that if you are a high-income taxpayer. What this means in practicality is that if you had been running into that $10,000 threshold before, as a tax professional, we were probably not asking you for things like sales tax on large purchases or RTA excise tax when you register your vehicles, those sorts of things, because you were already hitting the limit. Now that the limit is increased, we may be asking you for those things again. They may be helpful again. There's the new tips deduction, again from 2025 to 2028. There are a number of these things that just qualify for those few years. This is a deduction, not a dollar for dollar credit, but a deduction for up to $12,500, $25,000 if you're married filing joint, of tips received. If your income is over $150,000 or $300,000 if you're married filing joint, you don't get to take it at all if you're married filing separate. You can take this deduction. This deduction only applies for tips received if your industry is customarily tipped. Generally, this is restaurants, food service, beauty services, those kinds of things. The IRS has been directed to publish a list of eligible industries, but you can't just work around your business model to say everything is tips. It doesn't work that way. This deduction is also available for self-employed people, so this one will be one to watch going into this next tax season. You can't take a deduction for more than your business profit, and you'll still pay Social Security tax, Medicare tax on that profit. So a couple of things to keep in mind there. The overtime deduction, also quite hyped, also just 2025 to 2028. This deduction is for the amount over your normal rate. So if you're normally paid $20 an hour and your overtime rate is $30 an hour, the deduction is going to be that $10 an hour difference for those overtime hours. Again, it's a deduction from income, not a dollar for dollar credit, but it will help. And your income, again, has to be under $150,000, $300,000 if you are married filing joint, and not at all if you are married filing separate. A new deduction for interest on car loans. This only applies if you purchase a new car in 2025 to 2028. That vehicle has to have final assembly here in the United States. It's not for commercial or fleet vehicles. There are a number of restrictions and requirements on this deduction, so I don't want to get too deep in the weeds on this. The lender will need to generate a tax document. The VIN number has to be on it. It's complicated, but let me know if it's something that you would like a deep dive on in the comments below. Donations. There are a couple of different provisions that touch donations. The first one is that there is a new credit for contributions to scholarship granting organizations, including organizations that grant scholarships for elementary and secondary schools. So stay tuned if you have an interest in this one. There's more guidance that'll be needed. I can't get into too much detail there until we get more guidance. After 2025, there's also a deduction for monetary charitable donations, even if you are not itemizing. We had this briefly in the pandemic, but if you are giving to charitable organizations and you're not itemizing, you may take a deduction for up to $1,000 or $2,000 if you're married filing joint. If you are itemizing, they've added in something interesting in a bad way, that we'll need to, starting in 2026, subtract 0.5% of your income from your donations in order to calculate your deduction. So if you normally just give a little bit every year, chances are that 0.5% haircut is going to eliminate that deduction. Good news for those that are not itemizing, being able to take a deduction. Those that are itemizing, there may be some strategy there to do some grouping across years to get a better benefit. Changing gears a little bit, if you choose a bronze health plan from the exchange in 2026 and beyond, it will qualify as an eligible plan for you to contribute to a health savings account. So that can be a wonderful thing. And last, thanks for hanging in here with me. Last, you only have until September 30th to purchase a qualified electric vehicle for the EV credit, and the residential energy credits are ending with 2025. So you have till the end of the year to do things like windows, doors, insulation, certain heat pumps, those kinds of things, if you would like to take the energy credit for that. So this was all a lot. As I mentioned, videos on business provisions, kid provisions, those are all coming. Let me know if there are questions or if any of these items need more clarification. Feel free to leave comments down below on this or any topic. Thanks for being here today. Click like if this was helpful, to let YouTube know that others might get value from this information as well. Subscribe to be notified as the following videos come up, and I hope you have a wonderful day. I'll see you next week.